Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC meeting. We're going to discuss some of what Powell said. In addition, we're going to take a closer look at where interest rates are with respect to inflation. We might even go look at some of the inflation data. We're also going to take a look at the yield curve and see where we stand there. We'll look at the spread on treasury yields. And additionally, we will take a look at all this with respect to Bitcoin to some degree. So if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. So it's kind of nice because we get these FOMC meetings fairly regularly. We also get the job reports regularly as well. And so when we get those, it's a good opportunity to sort of dive into the macroverse to see what's what and who's who. If you're not up to speed with what happened today at FOMC, they kept rates remain unchanged at 5.5%. This was the general expectation going into the meeting, that they would leave rates at where they were at approximately 5.5%. If you remember, it was probably a year and a half ago where we talked about how 5.5% could be the terminal rate. But at this point, while back then 5.5% was seen as an outlandish number, at this point, we're more so wrestling with, will they actually go higher than 5.5%? Now, if you take a look at the SEP, by the way, is the summary of economic projections. They put this out at the meeting today. One of the things that's most important to look at is the dot plot, right? Now, if you're not familiar with the dot plot, Powell will often talk about this. It's figure 2 in the report. I will actually, if I can remember to do this, I will leave a link to this report in the description below. Sometimes I say that and then I just forget to actually link it. Let's hope that I actually remember this time. But I'll try to link it in the description below. If I don't, maybe someone just leave a comment until I actually do. But the dot plot, this shows you the FOMC participants' assessments of appropriate monetary policy, midpoint of target range or target level for the Fed funds rate. What you'll notice is that a majority of participants are actually suggesting that we need another rate hike in 2023. Now, there are some down here, 7, I believe, that say they think we're done. They don't really think we need another they're not really thinking that we need another rate hike this year, but you can see a majority of the participants say, you know what, we need one more rate hike. This dashed line right here is 5.5%. So anything above that dashed line sort of represents those people thinking we need one more rate hike. I am curious though. I mean, if you look at sort of expectations for 2024, there's one person here who thinks we need to go, up to around a little over 6%, maybe about 6.25 or so, which seems very, very hawkish. I doubt we go to 6.25, but who knows, right? Who really knows? We'll take it one step at a time. My sort of expectation is that 6.25 is too far, is too far to go, and I don't think it will make it there. Not in this business cycle. It could make it there in the next business cycle. I don't really think that we're going to be going back to zero interest rates anytime soon. They saw, some of the effects that has had, and I don't really think they want to go back to that anytime soon. So it's possible that we just are entering into, a period where we just have higher interest rates. Now, the path to higher interest rates is stochastic, right? I mean, we could go up to 5.5%, maybe slightly higher, and then go back down to 4% for a while, or maybe even 3%, and then go up from there if inflation starts to return. But that's where we currently are. The majority of market participants are saying, hey, we might need one more rate hike this year. My own personal opinion, right, if you want it, not that you asked, right, but if you care, my own personal opinion is that they don't really need to hike again. I think that what's more important at this point is not hiking any higher. It's just keeping rates at high levels at 5.5% for a long period of time. I think we are likely in sufficiently restrictive territory, which is what they even said. I believe Powell today, if I can find the quote, He even said, I think we see the current stance of monetary policy as restrictive. So I don't necessarily think they need to raise another 25 basis points. I'm open to the idea, but I actually think it might be a little bit much to do at this point. But we will see. I mean, oftentimes what pushes the economy into a recession is the Fed doing more than they really need to do and over tightening, right? If you look at the historical record for recessions, it's often the Fed pushes too far, and because they push too far, they end up breaking something, and then the economy sort of goes into a recession. What might be more interesting is not to care so much about what I think. What does the bond market think about all this? Because the bond market at this point doesn't believe the Fed, not collectively. If you look at projections for November 1st, by the way, this is only like 5 weeks away. They say the 70% chance that they're just going to hold at 5.5%. That's what they think right now. And honestly, that's probably about what I would put the odds at. 70-30. At this point, 70% chance that they might just keep them the same. I think one of the reasons why the probabilities are so low right now is because we do see inflation coming down, right? In some sectors, in a lot of sectors. Now, I know what some people are saying. They're saying, well, what about oil? Oil's going up a lot, and that might be true. And of course, the base effects are not as favorable. And we said previously we could see CPI go up again next month, at least year over year. We could see headline CPI go up again next month. But you have to remember that some of the lag effects from sort of the real estate market are likely going to start contributing more so, or becoming a headwind for CPI. Previously, they were a tailwind, but as we get further and further out, those headwinds those tailwinds for CPI could actually start to become headwinds. So that's an important consideration. That like some of these energy, the energy sector has been moving higher. We have seen oil go up, but we're also likely going to see the lagged effects from other areas start to kick in. So you could still see a scenario where the Fed keeps rates at 5.5% even in November. And what's more important to me is not really whether they raise another 25 basis points or not. It's just they need to hold it there for a while, right? At least a few months. I think that it might be a little optimistic by the bond market to think that the first rate cut won't occur until July. But we'll see. I mean, the economy has been resilient, but July, I mean, that's almost another year away. And so while it's certainly possible that that we just sit here at 5.5% until July, I also think it would be worthwhile to consider that rate cuts could of course occur well before that if the stock market sells off or something. Okay, now right now, we'll get into the stock market a little bit later. Let's look here at interest rates because this is interesting, and we'll talk about it with respect to Bitcoin as well. I said we would, so we will. But interest rates, you can see they really accelerated early on, but then they've kind of leveled off here, right? So you can see that interest rates have just been held flat here since July. And again, there is a chance that the terminal rate has been reached. We can't know for sure, but there is a chance that in fact has been reached. And one thing that I have previously mentioned, and I will mention it again, is to look at the Bitcoin chart. We'll go ahead and talk about Bitcoin. We'll go ahead and sneak in a little bit of discussion on Bitcoin right now before we get too much further. But do you guys remember this theory that we put out, I don't know, like at the beginning of the year? I think we first started talking about it at the beginning of the year. And I don't know, like I don't really put a ton of weight into the theory, but it is at least intriguing. And the theory goes something like this, okay? Last cycle, Bitcoin bottomed once we hit the terminal rate, right? Bitcoin bottomed at the terminal rate. Then Bitcoin rallied until the rate cuts started You can see it, right? Clear as day. Bottom, once we hit the terminal rate. Top, once rate cuts started. When did Bitcoin get when did the secondary scare terminate for Bitcoin? We always get a secondary scare. Everyone always thinks it's not going to happen. They say, oh no, new highs this year. People don't know what they're talking about. Everyone's going to front run the halving, all this sort of stuff. Secondary scare seems to always play out. What happened? Where did it terminate? At the last rate cut. So you can see that interest rates clearly corresponded to pivots in Bitcoin price action. You can clearly see it, right? I mean, bottom at the terminal rate, top when the Fed started to cut, bottom once we hit the last rate cut. Now, my sort of suspicion, and I've said this many times, is what if we know the Fed was so far behind the curve getting started here, but what if this cycle, this bottom over here, occurred not at the terminal rate, but the transition from 75 basis point rate hikes to 50 basis points? Because you can see that is where Bitcoin found its bottom, when the Fed transitioned from 75 basis points to 50, or at least its local bottom. And then we said, what if we propagate that onward and say when the Fed hits the terminal rate, that could mark the top for Bitcoin in 2023. And if you look here, when the terminal rate was reached, it was reached in the month of July. Potentially. We don't know yet for sure. There's a chance the Fed raises another 25 basis points. But let's suppose the bond market is right. Let's suppose the bond market is right and we've already hit the terminal rate. Then that means that our theory could actually be true in that the yearly high came at the terminal rate. Which is interesting because it sort of seems like we're just one step ahead from where we were last cycle. So what we could be looking at now is that Bitcoin is in a downtrend. I think it's in a downtrend. That's my expectation. I could be proven wrong, guys. I could. One way that maybe I'm proven wrong is if this is not the terminal rate, and the economy proves to be even more resilient, and maybe risk assets go up again, and then maybe Bitcoin could put in a new yearly high if that were to happen, and perhaps the Fed will be forced to raise again, and then that could mark it. But I think there's sufficient reason to believe that the yearly high for Bitcoin is already in. In 2019, the yearly high came in June. In 2011, the yearly high, I believe, came in June. It was either June or July. Yeah, it was in June. The yearly high came in June. So you have two examples of pre-halving years where the yearly high came in June. And in those two examples, we know that Bitcoin rallied in the first half of the year. The other example is 2015, where the yearly high did not come in June, but it spent the first half of the year going down. So 2023 is more similar to 2011 and 2019 than it is to 2015 in that regard. So then we propagate it forward and say, well, if this marked, if the top occurred at the terminal rate, then perhaps the next secondary scare terminates on the first rate cut. Perhaps. Oftentimes you see risk assets find their bottom on sort of the last rate cut. And we should be open-minded to that outcome as well. I think it would be silly to say that it can't play out like that. But just as someone who likes to observe these patterns, there's no denying that shifts in monetary policy have corresponded to major pivot points for Bitcoin price action. We know that the secondary scare tends to occur, and we know that it also tends to terminate sometime between now and the halving, right? That's sometime between now and the halving is when it terminates, okay? And so that, I think, is, well, I guess you could say between August and the halving, because in 2015 it terminated in August. But that is, I think, an interesting point. And the way we could see this coming about is that liquidity is drying up, right? We know liquidity is drying up. The Fed, they're continuing to tighten, right? They're continuing to tighten. And the issue is that at some point, the market is going to start to scream for help, okay? Now, the S&P hasn't really been asking for help yet. I mean, it's been on its own journey this year. It has not needed anything from the Fed. Now, crypto, altcoins have been stuck in traffic on Struggle Street basically all year. Some of them have had some okay rallies at some point. Most of them are just putting in new lows, right? So stuck in traffic on Struggle Street, just like they have been since late 2021. The issue is that the Fed's not going to pivot for your altcoin. He's not going to say, well, I feel bad about this altcoin and how great the community is. Let's pivot. When the stock market sells off, that is where you get major Fed pivots. The stock market will tell the Fed it's time. The stock market hasn't told the Fed that yet. So if the stock market hasn't told the Fed yet that it's time to pivot, then they're probably not going to pivot. And if they're not going to pivot, it means they're likely going to continue to tighten in some form or another. It could just be rolling assets off, reducing the size of the balance sheet rather than raising interest rates further. But they're going to continue to tighten in some way. And if they continue to tighten in some way, that's really not great news for your altcoin. Okay? So the way historically, the way you know when to buy altcoins is once the stock market really starts to give. Okay? Once that starts to give, then you start to know what's up, because then the Fed will look at that and say, all right, we've gone too far. It's time to pivot. So it's important to recognize that cryptocurrencies depend on excess liquidity a lot more so than the stock market does. A lot more so, especially altcoins. Bitcoin, not as much, but it's still a lot more dependent on liquidity than, say, the stock market is. Altcoin market, I mean, that's basically like their drug. If they don't get liquidity, they just sort of wither away and die. They need that liquidity to come back. So Bitcoin could actually bottom out before, say the stock market does, assuming we eventually get to that point in the business cycle, which I think will eventually happen. I mean, I've said before, I think this eventually ends, just looking at history, right? It likely eventually ends with a downturn in economic activity, forcing the Fed to pivot. The real question is just, when does that happen, right? That's the bigger question, when. And some people say, well, we already had a recession in 2022. Well, because we had 2 consecutive quarters of negative GDP, but it seems like somewhat of a weak argument considering that the unemployment rate, was at historic lows when that happened. So to call that a recession seems a bit of a stretch in my view, namely because when you think about a recession, you would think about, people losing their jobs. And the labor market has been extremely strong, so it's hard in my view to call that a recession. But that's at least how we can work Bitcoin into the conversation, is to say, well, at some point, I'm suspecting that Bitcoin is already in a downtrend. That's what I'm suspecting, and that it's going to remain in a downtrend until the Fed pivots, is my view. And that's the issue, guys. Is that the Fed, according to the bond market, the Fed's not going to pivot until July of next year. I'm guessing that's a bit of a stretch. Okay, I don't know that the Fed's going to make it until July of next year before a pivot. It's possible. Again, the economy has been more resilient than many people expected, but that is a bit of a stretch. Now, remember, there's this indicator, right, the yield curve, that has a pretty good track record for calling recessions, okay? Now, the biggest mistake that I think a lot of people have made this business cycle is that assuming that an inverted yield curve means recession now. But it doesn't historically mean recession now. What it usually means is recession later. Recession upon the uninversion of the yield curve. If we were to play this back to before the financial crisis, look at the yield curve. I'm just going to hit the play button, and I just want you to look at the yield curve. Okay? You can see here it looks pretty normal. This is in 2004. We're gonna go through this. Now it's 2005, 2006. Look at that inversion. Did you blink? Look at this is 2007. This is 2007. This is March of 2007. But if you were to go look at the S&P 500 in March of 2007, it wasn't, at that point, it wasn't necessarily obvious that we were knocking on the door of a recession. In fact, we were still in the process of going higher during that phase. And you can also see that during that phase, the terminal rate had already been reached, but the S&P was continuing to go higher in March of 2007. But eventually, the market rolled over. You can see the Fed started to cut rates here before the market rolled over. Because, again, the Fed goes too far. They cause a lot more damage than they intended to. And the issue is that just because they cut rates is not going to immediately fix everything. If people are if businesses are hurting just because interest rates are lowered, 50 basis points or something, it's not going to immediately solve all their issues. It's still going to be difficult, to sort of grow because they've just been facing restrictive monetary policy for so long. But again, March of 2007, if you looked at the yield curve and said that means recession now, well, you would have been wrong, right? But what did it mean? It meant recession later, right? It meant recession later. And you can see that as you go through this, by June, the yield curve was starting to look a bit more normal. Still some funky stuff going on, but it was a bit more normal. And especially by 2008, it looked pretty normal in 2008. But in 2008, that was when things got really bad, right? That was when things really started to get bad. It wasn't during the inverted yield curve. It was upon the uninversion of the yield curve, not the inversion of it. The inversion told you something was coming. It didn't tell you it was here. It just told you something was coming in the nebulous future. And, you have the ability to prepare for it if you want to. If you don't want to, you can ignore it. And you can go on about your day and hope that it doesn't go into a recession. But it told you that there's a good chance we go into a recession. And we did. And the same thing, of course, happened before the dot-com crash. Right? Look at the dot-com crash. Look at the inverted yield curve. We had an inverted yield curve then too. And then eventually it became uninverted. This is the uninversion of the yield curve in 2001. But the dot-com crash lasted until 2002, I believe. Right? This lasted until basically the end of 2002. This was October of 2002 before the market bottomed out. But in October of 2002, the yield curve had already been uninverted for a long time, but the market kept going down. So you have to remember, an inverted yield curve like we see today, it doesn't mean that it doesn't necessarily mean you're in a recession now, but what it does mean, historically, is that we likely see a recession later. And you can choose to prepare for it or not, right? That's up to you. There's always a chance it doesn't happen. I do believe if you go through the context of history, you might find an example here or there where we sort of avoided a recession in the short term. We still usually got one, within a couple more years. But for the most part, the yield curve has a pretty good track record. Another way to visualize this, by the way, is to look at Treasury yield spreads. And this is the spread on the 3-month and the 10-year yield. So you can see normally when you're in an inversion, like over here and over here, you're not in a recession. But it's upon the uninversion where the recession risk actually materializes. And there are cases where we were in a recession even during the inversion, mostly during prior periods of high inflation. Okay? So that is an important thing to consider. And again, look at this. It is the spread is starting to sort of get better. It's trending back to zero, right? Will it make it all the way there before it goes back down for a little bit? I don't know, but it is trending back up to that zero line. Not too long ago, it was all the way down here at negative 0.189% or so. Now it's up to negative 1.17%. So the spread is narrowing. It's not as the spread isn't as wide as it once was. So that's an important consideration to sort of make as well, is that it is sort of trending back in this direction. It is still negative, but it's not as negative as it was, say, in the summer. So an important distinction to make. Now, there's a couple other things that I wanted to mention, and one of those is, and actually before I get too far, there's this on the website now, on the Into the Cryptoverse website, we now have a macro recession risk dashboard. So we've been working a lot on the macro side of things, where we have these risk metrics for the labor market, national income and production and business. And what you notice is that these three risk metrics don't really say we're in a recession, right? Like if you were to look at national income and product, I mean, it is going up, right? The risk of a recession based on national income and product is going up, and you can see what it's based on: real GDP, real GDI, real gross private domestic investment, imports of goods and services, federal government current tax receipts, real gross national product, and this one's not actually included, but if we were, it's real gross national income. You can include it and see what it would actually make this even worse, like we're more so. Recession risk is going up. But that is what it looks like currently. So recession risk is starting to go up some. I don't want to spend a lot of time on this because maybe it would be better for a different video. But all three of these risk metrics are low in the grand scheme of things. The issue is that they're probably only going to go up after the recession is already here, right? Like, so maybe national income and product will go up before the labor market risk goes up. The issue is when the labor market, by the time the labor market risk goes up in a sort of in a sustained way, the recession's already here, right? And you can see that it went up last year a little bit, but then it came back down. Now it's starting to go back up again. So that's the issue, is that by the time you see it over here, the market's already priced it in, right? The market's already priced it in. But we have this other risk metric based on interest rates, more specifically based on treasury yield spreads between the 3-month and the 10-year yield. Now look at this one. When you look at this one, it's absolutely screaming recession, right? But remember, this one doesn't tell you recession now. This one tells you recession later. The labor market risk indicator will tell you recession now. The yield spread risk indicator will tell you recession later. And right now, it thinks we're going to have a recession later, right, at some point. And you can see historically when the risk goes up, once it starts to come back down, that's where the recession occurs, right? There are examples where we go up to pretty high risk and come down, only then go straight back up and then, in short order experience a recession. I think the longest one was back over here in like 1966, where we went up to pretty high risk. We came down, we went straight back up to high risk again, and then we got the recession. So basically in all cases, a recession occurred. Sometimes it did take another year or two for it to really manifest, right? I mean, this risk here peaked out in 66. The recession didn't arrive until about 3 years later in 1969, going into 1969. So that's a pretty long time, right? And you might say, well, is that really worthwhile? 3 years later? I think it is, not in the sense that it necessarily would have helped you with a short-term investment, but the reason why it's important is because the market still put in a new low. And that's what happens in recessions oftentimes, is the market puts in a new low. So that's the issue. It's not going to be the perfect predictor on exactly when a recession occurs, but it sort of tells you that one's coming in the nebulous future. And if that's correct, then it means that the prior low could be taken out. And for the S&P, that prior low, of course, would be, just around 3490, I believe. I believe we went just below 3400. So that would be where that prior low is. And, I would be interested in the pre-pandemic high. Could be a major low if we were to take this low out. Now, with that said, one of the things we mentioned with the S&P is that we would likely get a pullback in August and September of the pre-election year, because that's what it normally does. And you can see this is August and September of the pre-election year. We have a pullback. Now, here's the trick. We don't know if this is the recession pullback, right? We don't know if this is just going to continue into a recession or if we're just going to rally up in Q4. You don't know. I don't know. We can, of course, all make our guesses, but no one really knows. And sort of what I would say is that if we don't really see the labor market loosen up in the short term, then there's a chance that the S&P could rally in Q4, right? If we don't see the labor market loosen up. But if the labor market starts to really go in the short term, then this pullback could turn into a more sustained and significant pullback. And what I mean by that is if you were to look at say, the unemployment rate. So let's go take a look at the unemployment rate. First of all, if you just look at the measured regularly, the way that everyone knows that we all measure it, right? 3.8%. it's still relatively low, right? It's not really off that far off the lows. But the issue is if we measure unemployment differently, there's another measure, U1. So the way we look at it is U3, standard unemployment rate. There's another way to look at it called U1, which is greater than 15 weeks unemployed. This one is starting to go up, right? Like this one is actually starting to make a significant move to the upside. And you can see that when it does, it usually leads into a recession. So, my answer to whether we rally in Q4, I mean, it's going to be dependent on whether the recession risk actually materializes between now and then. And if it does, then, we probably won't rally in Q4. If the recession risk does not materialize, then we likely do rally in Q4. There's all sorts of reasons you could point to why the market should go down. But again, the market loves climbing the wall of worry until it has sufficient reason not to do so. And usually that sufficient reason is the labor market. Now, sometimes that sufficient reason could be some type of geopolitical event, but those are nearly impossible to predict. I certainly can't predict them, so I'm not going to spend my life, worrying about geopolitical events. But the labor market, I think, is something we can more so look towards and say this is something that if it starts to really go up, that's what leads into a recession. And when a recession occurs, the market normally sells off. Okay. Now, that I think is sort of the bigger risk that we have right now. Now, if we were to look at this here is interest rates, right? So this is the effective interest rate in the United States. You can see that we are pretty high up right now, pretty high up. What's more interesting is that we've gone above inflation. Now, if you look at this chart, you can see that oftentimes during an inflationary period, the Fed will raise interest rates above inflation, right? So in this green line, this yellowish green line is the effective interest rate, the effective Fed funds rate. The orange line is inflation. And you can see that when we have high inflation, the Fed, they typically raise rates above where inflation is to really bring back down and crush inflation. You can see back in the 1970s, they did this, but they kept pivoting too quickly. And it just kept leading to another round of inflation. Powell wants to avoid that this time, right? He doesn't want to go through this again. He doesn't want to, and he even mentioned that today. He said, let me find the quote. I'm going to find it. Theoretically, I could find it. Yeah, it can be a miserable period to have inflation constantly coming back and the Fed having to tighten again and again. When he says that, this is what he means, right? Look what the Fed had to do. They would raise rates, and then they'd say, oh, inflation's coming back down, let's lower rates. And then inflation would go back up, well, let's raise rates. And they just kept playing the game. And then finally, they came in and they just kept rates high. Well after inflation started to come back down, they crushed it. And then you can see inflation stay down. And the reason why that was a good thing was because then we went on to our next phase of economic expansion. Go add in here the S&P 500. Look at this. Look what the S&P did after inflation was destroyed. Destroyed might be a strong word, but tamed. In the early 1980s, just a long period of economic expansion. The S&P went up, inflation was well anchored, and interest rates were well above inflation. I think Powell is trying to achieve that. I know that's what he's trying to achieve because he has said it many times. He does not want to go through the 1970s. He wants to bring it down, and he has said many, many times that price stability is one of his first opening quotes today. Price stability is a responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. And, a common retort would be for people to say, well, if you get a recession, people are going to get laid off and they'll lose their jobs. That's true. But you know what else sucks? Going to the grocery store and spending, $300 for something that probably used to cost you $130. I mean, that kind of sucks too, right? And how much longer do you think people can take of that before their savings are just simply bled dry? So that's really the issue I think that we're fighting, is that Powell recognizes that a recession would be detrimental for people that lose their jobs, but it's also detrimental to have inflation that is running as hot as it is and going on for as long as it is, because now everything that we used to buy for much cheaper now costs a lot more. We're all feeling that. You can't order anything, you can't buy anything anymore without it costing a lot more than it used to. So that's an important consideration to make as well. And when you think about inflation and where inflation is, we have seen a lot of progress, right? And we have. The issue is we don't want the Fed to screw it up by pivoting too soon. Let's hope they do the right thing. And we said this a year and a half ago too. Let's hope that Powell means what he says. Let's hope they have the resolve to see it through. Because if they don't, then this is what you get. You get another round of inflation. And look at this over here. Look at where this bottomed out. It bottomed out in the summer of 72. Right? It bottomed out in the summer of 72. What's also interesting is this bottom over here was the summer of 81. Right? So we have two paths that you can look at. Path A is we bottom out, right? And look at it, it's the same level too. The same exact level where it bottomed out. Isn't that fascinating? Let's get the exact number. Where did it find its low? Inflation year over year. Look at that, like 2.96%. 2.96%. Where did it go this time? 3.09%. In the summer of 2023, this was the summer of 1972. This path led to another peak in inflation that took out the prior peak. I don't want that. I would prefer the Fed to stay the course until the job is done. And in the 1980s, the Fed stayed the course until the job was done after they spent a decade learning their lesson as to what not to do, right? So look at this one. It bottomed out in the summer. It went up for a few months into September, right? So we'll get September's data next month. And then it just dropped, right? And then it dropped. And so too did the S&P. Big drop by the S&P. The drop by the S&P, by the way, started in August. You can see right here, it started in August. This is where this one started, in August. I'm just saying, right? I'm not saying, you know what I'm saying? That's what I mean. Like, I just want people to be aware that we've seen these trends before, and I think, my own personal opinion, I think it's more likely that they stay the course until the job is done at this point. I might have to change my mind if they, if something happens and I think they're sort of, if I think they're forced to pivot for other reasons, like some major, unexpected event occurs. When we had the pandemic, of course, that threw a wrench in monetary policy for a while. So you never really know. But at this point, my expectation is that they stay the course until the job is done. And that is to keep rates elevated for as long as they can. And that, I think, is where the pain comes in for crypto, especially, and for stocks, but really for crypto too. Because this is where the market is going to be screaming for help. And what if it doesn't come? Because the Fed doesn't want to pivot, right? What if it doesn't come because the Fed says, no, we don't want inflation to come back next cycle. And so they keep rates high and high and high, and the market just goes lower, and altcoins bleed. Look at the dollar. Look what's going on with the dollar right now. I mean, if you haven't been following the dollar, you're doing something wrong, because the dollar is on an absolute rampage. It has been anyways. Look at this move by the dollar. It's up to 105. Now, I will say, this is 10 green weeks in a row, right? We're gonna have a pullback at some point. I've been bullish on the dollar for this entire move, but I also would expect us to have a pullback at some point. But this is also one of those things where it just keeps going up, and people keep calling for a pullback, and then it just doesn't happen. Now, if you watch my other videos, we talked about Bitcoin's Bitcoin's death cross, right? And we said, all right, well, Bitcoin just got a death cross. It usually rallies into the death cross and then rolls over and continues the overall trend, right? So my expectation with Bitcoin is that it does eventually roll over. Does it roll over at 27K or 28K or 29K? I don't know. I suspect it's going to be a lower high. But with the dollar, I believe, if I'm not mistaken, we should be coming up on a golden cross soon, if not already. Yeah, we're getting a golden. Yeah, you can see right here, right? So we just got a golden cross. So with that in mind, you could get a pullback in the dollar at some point, right? Normally, it does the reverse of what you expect because it tells you what you already know, right? Like if you get a golden cross, it means that it's been performing exceptionally well, and it has been. So I would be on the lookout for that. Like, there could be a pullback in the dollar, and it's also coming into these highs over here. So like, if you look at once it sort of approached this level here, right? Once it approached these weekly candles right here, where we sort of topped out on the weekly, you can see that the dollar had a pretty nice pullback. So now it's sort of right around these levels, at these candles up here. So it's certainly possible that we get a pullback. But even if we do, I mean, it's just par for the course, right? If we do get a pullback, I would still expect the overall trend to likely remain intact. And that's the issue, is that liquidity is just simply coming out. I mean, it's just being removed. Go take a look at the balance sheet of the Fed, right? So go take a look at the balance sheet. We don't need moving averages on this. You can see the Fed just continues to remove assets, to reduce the size of the balance sheet. Now, I think it's important to consider that liquidity comes from other places as well, right? It's not just the United States. It's not just the central bank's balance sheet. So that's why we will often pull up the net liquidity model, which includes the Fed, the ECB, Canada, the UK, Australia, New Zealand, China, and Japan. All those central banks. We subtract out reverse repo and the TGA from the United States, and you get this model. And as long as the dollar is going up, then in general, it's going to be a headwind for net liquidity, because the balance sheet of all these other banks, we're converting it to dollars, right? And if the euro is going down against the dollar, then liquidity, it's drying up, right? It's simply drying up. And, we've talked a lot about how Total 3 tracks net liquidity pretty well. You can move this over to the chart and just sort of see that it has been tracking it fairly closely for a while, right? Total 3 and net liquidity. So I love the Cryptoverse because it makes more sense a lot of times than like the S&P, because the S&P will do all sorts of things because it'll diverge from net liquidity, right? So like you see how Total 3 tracks net liquidity, the altcoin market tracks it quite well. It makes sense. The S&P, it does not track it that well. The jaws love to open up at certain points, and you get a divergence between net liquidity and the S&P 500. But the issue is that while it diverges occasionally, like over here and over here, the issue is that eventually the S&P falls to where net liquidity is. Okay, it falls back down. I mean, these are on separate scales, but just you get the idea, right? It sort of falls back down to those levels that it would correspond to from where it previously was. So like now, it's the net liquidity model is where it was back in late 2022. But the S&P hasn't seemed to care. It loves to diverge from net liquidity. Whereas Total 3 doesn't really diverge as much, right? It tracks it fairly well, in fact, right? You can see Total 3, it tracks it really, really well. So the altcoin market is really interesting because it really does actually make more sense, just from like a logical perspective. Oh, liquidity is drying up. Oh, then the riskiest of assets are probably going to do poorly. Oh, they've done poorly. Many of them keep putting in new lows. That makes sense, right? Like that makes a lot of sense. Whereas other asset classes don't necessarily follow that, because they depend on other things, right? They depend on profits and other stuff. A lot of altcoins are just dubious speculation, right? That you say you have a great community and whatnot, but that's about it. And so it's more so dependent on that excess liquidity. And that's why once you see recession headlines saying a recession is actually here, that likely means liquidity is coming back and the altcoin market is bottoming out. But I don't think the altcoin market is bottoming out when the S&P is at 4,400, and normally speaking, the S&P doesn't. I mean, it has to start dropping before the Fed pivots, right? And we haven't even gotten to that part of the business cycle yet, right? We're still not even there yet. So that's kind of where we are with this mess. I mean, this is a lot to talk about. There's a couple other quotes that I wanted to say. A couple of interesting things just for the record that Powell said. He did say the full effects of our tightening have yet to be felt. The process of getting inflation sustainably down to 2% has a long way to go, right? He's saying it has a long way to go. He said, if the economy evolves as projected, the median participant projects. Let me pull up the SCP. The median participant projects that the appropriate level for the Fed funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. So the median participant projects that the Fed funds rate will be 5.1% at the end of 2024. That's not that much lower than the current Fed funds rate. So there's not a lot of rate cuts being priced in right now. He also said we are prepared to raise rates if appropriate. Right now, market doesn't believe him. Okay, they don't. I mean, they while the median participants are saying we probably need another rate hike this year, bond market doesn't believe that. Okay, they're saying, you know what, probably not, probably not. The bond market's also saying that if we do get another rate hike, it's more likely to occur in December than in November. Okay, so the bond market says. He also said another interesting thing. A reporter asked him, would you call the soft landing now a baseline expectation? Powell said no. But I don't think he means that it can't happen. I mean, again, like the path to a hard landing is thinking we get a soft landing anyways, but I don't think he's saying it can't happen. He just said that shouldn't be like a baseline expectation. And he sort of snapped back at another reporter because another reporter asked him, like, well, why is it not the primary objective? He didn't say it wasn't the primary objective. He just said it's not the baseline expectation. So then he was like, well, to begin, a soft landing is a primary objective. And I did not say, he says, I did not say otherwise. That is what we have been trying to achieve all this time. The worst thing we can do is fail to restore price stability. Going back to this chart, right? He knows what happens if they fail to restore price stability. We get a decade-long period where he said it can be a miserable period to have inflation constantly coming back and the Fed having to tighten again and again. I don't want to live through that decade, that theoretical decade. I doubt you do. I would prefer to just get it over with, right? They just try to get inflation back down to 2% and let's move on with their lives rather than deal with this for the next decade. That would be ideal. Obviously, things are much more complicated than that. But if the Fed stays the course until the job is done, they could have a lot better odds of conquering it than if they were to pivot too soon. I think my favorite thing that he said today, which I think resonates, it should resonate with everyone here, especially people who make price predictions, which I think is all of us, right? Who hasn't made a price prediction here that hasn't been, just completely wildly untrue, right? Or didn't pan out any way that you thought or I thought, right? But he said, forecasters are a humble lot with much to be humble about. I think it's a great quote. Forecasters, because someone asked about should we really believe your forecast? Because, here's your track record. And here's the track record of all these economists. He says forecasters are a humble lot with much to be humble about. I think it's a great quote. I mean, it's sort of just a reminder that no one really knows where this train is headed, but we'll do the best we can to project out the most likely outcomes, and we will take it one step at a time. I hope this video has been useful to you guys. If you guys like the content, make sure you subscribe and give the video a thumbs up. And again, we do have the sale on Into the Cryptoverse Premium at intothecryptoverse.com. And of course, you can get access to these charts you've seen me talk about on the website in this video. We have a lot more as well. As you can see over here, we have all sorts of categories for jobs and employment and unemployment. I mean, this is called Into the Cryptoverse, but it's a lot more than that. I mean, we have all sorts of other stuff going on over here. Anyways, we'll wrap it up there, guys. Hope you enjoyed the video. Sorry it was a bit long. Hopefully it wasn't too long, but I will see you guys next time. Bye.